Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on today's market action. We're still looking at gains, although off the highs of the day. The Dow up just over 100 points. S&P in the green as well, up just around 0.1%. Nasdaq 100, though, back in negative territory, off about 0.1%. I want to turn to the action that we're seeing in the bond market. An announcement from the Bank of Japan just in terms of the movement that we could see in the yields. That pushed yields higher here. We're looking at a 10 basis point climb. We'll get a little bit more about that in just a minute. But the 10-year yield today at 3.68 here in the U.S. The 30-year yield also pushing to the upside. Taking a look at where things are in the crude market and energy market. Crude moving to the upside today, up another percent, above $76 a barrel. Taking a look at the sector action today, a number of sectors are holding on to gains. We're seeing energy lead the way, followed by materials and financials, real estate and consumer discretionary lagging behind. Consumer discretionary off just about 1%. We will be getting earnings from Nike and FedEx after the bell, so certainly we could see some movement, not only in the final hour trading, but that extended action is something to take note of today, Dave.
Sounds good. We see real estate there in the red. Let's get you up to speed now on housing. A big week on that front continues today with housing starts falling 0.5% from October and down 16.4% from a year ago. That's according to the Census Bureau. Single-family housing starts dropping 4.1% at their lowest level since May 2020. Yes, as you know, the early days of COVID. Building permits also falling in November, down 11.2%. They are always down in November, mind you, 22.4% lower than a year ago. Much more on the big picture in housing later on in the program. But let's go now to Jared Blickery, gets us up to speed now on a major mover out of Japan reverberating around the planet.
Quite a bit of surprise here from overseas overnight. You can see the U.S. dollar has now sunk 3.86% versus the yen. That is a huge amount, and I'm going to get to the significance of this in a second, but I just want to show you that price movement. This is over the last 2 days. Now, on a year-to-date basis, you can still see that the U.S. dollar is elevated relative to the yen. In fact, from here, from basically the baseline to here was something like 20, 25%. You usually don't see this big a move in currency terms. However, the Bank of Japan decided that overnight it was going to do something it was not expected to do until the current chair, the equivalent of Jerome Powell over there, Haruhiko Kuroda, until he leaves next April. So here's the 10-year Japanese yield curve control chart. Now, this goes back to 2016. This band here tells which are the acceptable levels for the yield curve for the 10-year over in Japan to trade at. And you can see it. At first, it was from about 20 basis points under 0 to 20 above, and then it was 25, and then it was 50. Well, now it's 50, and we can see in one day yields have climbed this gauntlet here, and really it's just a pressure valve. So bottom line, the Japanese authorities have released a pressure valve, and we're going to take a deeper dive in a few minutes into the U.S. bond market and figure out what this has in store for U.S. equity investors. But a move like this tends to happen at the end of the business cycle when we're heading into recession. So just kind of a cautionary tale here. Like I said, don't make too much of out of this because it's in the holidays, but it's perhaps because we have lower liquidity and maybe these moves wouldn't upset too many investors into the end of the year, guys.
All right, Jared, thanks so much. Let's talk about what this could mean for the broader markets, how investors should be looking at this announcement from the Bank of Japan. For that, we want to bring in Alfred Eskandar, Salt Financial President and Chief Operating Officer. Alfred, it's great to see you again. So it looks like, more broadly speaking, that Wall Street is shaking off this surprise announcement from the Bank of Japan early this morning. How are you, though, looking at it just from a market's perspective and what this could mean for equities moving forward?
Well, I think the big news here was the big surprise, completely unexpected. Global markets reacted much stronger than we did. If you take a look at the open to today, the trading right now, markets really haven't responded that much with the exception of the 10-year moving up 7 bips. Overall, I think what this ultimately means is that you're going to start seeing some yield in the Japanese market. And if you look at the Japanese investor for the last X number of years, they've been chasing yield outside. So presumably you could expect more onshore investing from Japanese institutional retail.
Why do our markets so quickly shrug it off, Alfred?
A couple of reasons. One is, we have been sort of lulled into this current environment where we know where rates are with the states. We have incredibly efficient and very liquid markets. News dissemination is incredibly strong, so there's very few shocks or news breaks that tend to rattle us. I think that's one big difference between the U.S. markets and a lot of other markets around the world.
Alfred, in terms of how this sets us up for the final 2 weeks of the year and then looking forward into 2023, anything at this point to be a little bit more optimistic about?
I tend to have an optimistic bias, so Shauna, you're probably asking the wrong person. I look at 2023 as a real opportunity for bonds and for multi-asset portfolios. So if you think about your traditional 60-40, which didn't work this year, really has a strong chance of regaining its sort of risk-controlled view. When you combine different asset classes together in a single portfolio, you will reduce the overall volatility and risk, is what investors ultimately want. And I think given where rates are in the U.S., it's going to have a lot of competition for equities. Certainly when you're able to get bond indices in the neighborhood of 4.25, 4.5, versus where they were last year of 1.7, it's pretty attractive. Certainly attractive to older investors, more risk-averse investors, and you could finally clip a coupon that actually means something this time.
But Alfred, we have driven the final nail in the coffin of the 60-40 about 20 times this year. It's good to hear it come back from the dead. Are you ruling out any type of Santa Claus rally here?
Well, I mean, I don't know how many exact days we've got left. It's already the 20th. Anything could happen. I doubt it, to be honest with you. Just looking at overall volumes and participation in the market, it's a little bit light. I think everybody would love to put 2022 behind them and just kind of, start the new year off with a better viewpoint and a much better chance of recouping some of the losses from this year, because the indices have gotten pretty bad.
Alfred, when you take, I know you prefer bonds right now, or you're seeing more opportunity, I should say, at least in fixed income. When it does come to the equity market, the whole debate over growth versus value, whether or not growth is going to maybe regain some momentum in the new year. Do you see any truth to that, or does it make more sense to stick to some of those value plays?
No, I mean, value and even some small cap stuff would probably play better out in next year. If you think about growth, it's gotten its butt handed to it this year, and it's still elevated in terms of where the growth stocks are being priced relative to their earnings. So I think value will certainly has a better chance. I mean, no one has a crystal ball, but if I was to put money to work, which we will, it will be value oriented. Continue to put money in defensive sectors, and again, look to manage risk by including a mix of different asset classes in the portfolio. And I've said this before on your show a few times, and that is there's plenty of products out there that kind of offer the ability to mix different asset classes together, so the novice investor does not have to try to figure it out on their own. Additional products, which also include buffer ETFs, fixed index annuities that also protect downside completely or to a certain portion. There's a lot of product innovation, and I really urge investors to look beyond just picking single stocks every time.
Will do. And Alfred, I always look beyond as well. I look at your Zoom shot there. A++ for having wine in your office. That is a first in my book. And really, that's a great move. At the end of the day, you don't have to go far. Alfred, thanks so much for being here. Merry Christmas to you. Let's get over to Jared Blickery now. A lot of talk about the bond market. What do we see happening after a brutal year in 22?
I agree. We're ready to put this year behind us. And so let's take a look at where we are in the bond market. This is basically the entire history of the U.S. And U.S. bonds right now on track for their top 10 worst return since the birth of the Republic. And here we are all the way over in 2000. 2022. Here's that negative red candle. That's basically down 14, 15%. You don't see that often going back 200 plus years. Now, you do see that in this area in here in 1916 to basically 1980, I guess it's not circling right now, in here you do have a lot more down years, but my point of putting this up is that you can have several, up to 5 down years in the bond market cluster together. Now, when we talk about the 60-40 portfolio, that adds some diversification. And so if we were to look at what's happened with a 60-40 portfolio since 1950, here's this nasty downdraft that we have right here. That's down 22%. Here's March of 2009, down a little bit less. Now, what we had going for us in March 2009 was the Federal Reserve was amping up. It was getting ready for Bazooka QE1, and stocks took off to the upside. Bonds didn't do much, but we had this balanced portfolio. So the question is, what happens with correlation? Now, this comes from Bespoke, and this shows the rolling 3-month correlation between stocks and bonds over the last 5 years. In the early days of the pandemic, we shot up, and now we're up here again. That means if bonds are going up, that means if yields are going down, that means equity should be going up, and vice versa. And what the problem is, we've been having these scary surprises up in bond yields. So that means bonds are going down and equities are going down at the same time. Now, here is the critical chart, and this comes from Jim Bianco. This is where the rubber meets the road. This is what the Fed is forecasting it's going to do in the blue line versus the market. What the market thinks is going to happen in the orange and green line. So the Fed in 2023, this goes through each month of the year, they think they're going to raise rates in the early part of the year up to about 5.25%, and then they're going to hold there from May until the end of the year. The market's saying no. These lines here are what the market expects both before and after the Fed announcement last week. They're saying that there's going to be a come to Jesus meeting sometime, and we're going to see what the difference holds. At that point, in theory, we should get a nice downdraft in yields, and because stocks and bonds are still highly correlated, perhaps at that point we get that updraft in stocks, and then we get that liftoff that everybody's been expecting. But the problem that has happened so far this year, everybody's been front running this trade, has not happened yet. So if it happens in the first part of the year, maybe that's something to look forward to, but not in the present circumstance, guys.
Something to look forward to. Excellent breakdown there, Jared Blickery. We will take it. Thank you, my friend. We are just getting started here on Yahoo Finance Live. Coming up, time for Disney to ditch ESPN. We'll tell you why one prominent analyst thinks so. And the National Association of Realtors chief economist tells us if we are in a housing recession or not. And a pair of industry giants reporting earnings after the bell. Will bring you the numbers from FedEx and Nike, as well as analysis on both as soon as they break.
Netflix's new ad tier appears to be struggling. There's a new study out saying that the streaming giant's $6.99 ad plan accounted for just 9% of signups last month. Yahoo Finance's Alexandra Canal has more on this story. Ali, going into this launch, there was certainly a lot of hype. Maybe this is what Netflix needed to do in order to attract new users. Doesn't look like that's happening, or at least just yet.
Yeah, not smooth sailing, at least from the start, according to these various reports. And that data was from Antenna. It's a streaming analytics firm cited by the Wall Street Journal, and it noted that the ad tier accounted for just 9% of signups for the month, with 43% trading down to that cheaper plan. Now, to compare this to a competitor, we saw HBO Max have stronger results when it launched its own ad-supported offering in June 2021. At that time, 15% of new signups were seen in the U.S. during that first month, with just 14% of users trading down. So if you compare apples to apples there, the Netflix tier is struggling a bit. I did reach out to Netflix for comment. They said, quote, "There are a number of inaccuracies in this reporting. It's still very early days for our ad-supported tier, and we're pleased with its launch and engagement, as well as the eagerness of advertisers to partner with Netflix." But let's talk about that for a second, because last week we saw a report from Digiday, which said the streaming giant fell short on viewership guarantees it made to advertisers for the ad tier, and was then allowing ad buyers to take their money back. At the heels of that report, the stock plummeted 9%, the largest intraday drop since April. So this is something that investors are heavily watching. We spoke with Tim Nolan on the show from McGuire yesterday. He said that by and large, it's still early days. This is going to take time. He anticipated incremental revenue will not happen till 2024, 2025. But if they do fail on this, that's going to be reflected in the stock price, because this was a huge part of Netflix's growth and recovery story.
I don't see it advertised a lot. I'm curious about that. And maybe people don't know yet. Still the early innings. All right, we want to stay with some media news. A bold prediction from Wells Fargo on the future of ESPN. What is Stephen Cahill saying, and why does it matter so much?
Yes, his 2023 media predictions. And he said this has been a tough year for media, and 2023 will lead to some very tough decisions, in specific to Disney. He said that he anticipates ESPN will spin off, which is a very bold call, very polarizing topic amongst analysts. He wrote, quote, "Disney will begin the spin-off process for ESPN and ABC, including launching ESPN and streaming a la carte. Cost rationalization and balance sheet options are critical to reaching this outcome. The result is a better off remaining Disney." Now, Disney has struggled in terms of profitability, particularly with that direct-to-consumer streaming, which includes ESPN Plus, Hulu, and Disney Plus. It did lose $4 billion for 2022. However, ESPN has funded a lot of those endeavors. So that's sort of the flip side of the equation. Some analysts have said, look, how can you get rid of ESPN? This is a really viable asset to Disney, but then others have come out and said they could get a pretty big paycheck if they were to spin this off.
From who? There seems so few. Apple, Amazon, beyond them, it's not entirely clear. Cahill, very well respected, very plugged in, but most think ESPN is the stickiest thing Disney has for these bundles. All right, Ali, stick around. I want to talk to you about this. As evidenced by the record 16.8 million people that watched the World Cup final Sunday on Fox, sports viewership has never been bigger. But could trouble be right around the corner? Perhaps, according to a new study from Morning Consult, which shows that Gen Z watches dramatically less live sports than older generations. In fact, 47% of U.S. adults watch on broadcast or live TV, just 28% of Gen Z, and a full third of Gen Zers don't watch sports at all. So while these sports media rights are massive and continue to expand, there is some trouble around the corner, which really leans into streaming.
Yeah, and these industry executives, especially in this space, they want to cater to Gen Z. How do they attract that Gen Z fan base? Also in this study, nearly half of Gen Zers said they have never watched a professional sporting event live, which is crazy to me.
Wow.
But if you think about it, they are growing up in this generation of cord cutters, right? So that barrier to entry is a little tougher than it was when I was growing up. Even for me, I subscribe to YouTube TV, but if I want to watch my Eagles on a Sunday at 1 p.m., I can if the Giants or the Jets are on. Yeah. So already there's that issue there. So if they're flocking to those sites like TikTok, YouTube, Snapchat, where you can't watch a live sporting event, maybe that's what's contributing to their lack of interest in it.
Yeah, and I think just purely a number of options that they have right now out there. Like, I think when a lot of us were growing up, you were more accustomed to maybe watching some of these games. You would sit down with your family. Now there is just a plethora of options out there just in terms of sitcoms. Anything you want to watch is at your fingertips. So this whole streaming era is very different. And I also just think that Gen Z doesn't have maybe the focus to sit there and watch through hours and hours of games. You talk about it all the time. Your son likes to watch Red Zone when it comes to NFL. So he's watching the live footage, which a lot of Gen Z isn't doing. But I think people more want to know what the outcome is rather than sit down and enjoy the game, which I just don't really understand.
I have a 16-year-old who didn't watch a single live sporting event until the World Cup this year. They don't have a whole lot of loyalty to teams either, and that's not a knock. They just grew up in a different world where teams don't matter to them. They like content, they consume content, but they won't sit, to your point, and watch 2, 3, 4 hours of one team because they don't have that loyalty. Big implications.
I blame the parents for this because I have 2 young cousins that are very hardcore. And if you have a parent, so what about you?
I blame the phone.
You blame the phone. Okay.
Social media.
You're a dad,
it's hard to
so
keep
I
their
understand.
attention.
Social media, it is the TikTok generation. Allie, excellent reporting today. Thank you. All right, billionaire mortgage lender Matt Ishbia is planning to buy the Phoenix Suns, according to ESPN's Adrian Wojnarowski. The deal expected to be completed in the near future, according to the report, and could close at an NBA record $4 billion. Now, the Suns sale includes the WNBA's Phoenix Mercury, but still dwarfs the next highest NBA purchase ever, which was $2.35 billion for the Brooklyn Nets in 2019. And the deal is actually in the vicinity of the record sports purchase, which was $4.65 billion for the Denver Broncos recently. So, wow, this is a huge number for an NBA team, not in a marquee market. Ishbia, the CEO and president of publicly traded UWMC Holdings, will be buying the Suns from Robert Sarver, who put the team up for sale after an investigation found he created a toxic, hostile work environment. Coming up, the National Association of Realtors chief economist tells us which cities will have the hottest housing markets in 2023. As more data comes in showing a struggling housing sector, the National Association of Home Builders CEO, Jerry Howard joined the show earlier today to tell us what they see happening. Listen.
So cost of construction, the cost of capital, it's all playing into it. And that's having an impact where we firmly believe that we're in a housing recession right now.
Joining us now to weigh in on this is Lawrence Yun, National Association of Realtors Chief Economist and Senior Vice President of Research. Lawrence, nice to see you as always. Are we in a housing recession? And how do we define it? We got caught in that trap with the overall definition of a recession recently as well.
Well, good afternoon. I would definitely say we are in a housing recession because it's contributing negatively to the GDP growth. It's cutting into it. Housing starts are down, home sales are down, there's some layoff in the industry. But the most interesting aspect from consumers' point of view, homeowners, they're doing fine. I mean, they have seen substantial growth in their wealth from rising home prices, very little foreclosure rate, mortgage default rate at historic low. So we have a divergence. People in the industry suffering due to the lack of activity, yet homeowners are doing very well.
So, Lawrence, we have housing starts off 16% from a year ago. Permits are down 22% from 2021 in November. Just in terms of what this is signaling of how much worse the industry could potentially get over the next 12 months. What do you think?
Because of the lack of buyers, the builders are becoming very cautious. Now, we have to remember, we had a housing shortage before COVID. Inventory levels were low. Then the first couple of years during the COVID, when the home sales boom, we had an exacerbated housing shortage with multiple offers widely prevalent. But now with the buyers retreating because of much higher mortgage rates are the drivers. High mortgage rates, buyers retreating, we still have some degree of housing shortage, but definitely it's taking much longer to find that right buyer in order to make that sale.
Mortgage rates up on the screen, and they are down considerably, frankly, from north of 7. That's maybe the only good news right now. Where do you think they settle in at middle of next year?
I would say 5.5% is probably the case because you have the Federal Reserve who will continue to raise interest rate probably 2 more rounds. But the mortgage rates have already priced that in that information, and with the inflation expected to retreat, from the 9%, 8%, 7%, and possibly 4% inflation by end of next year, that means that the Fed may be able to cut interest rate towards the year end, which means that mortgage rate may be pricing those future possibility into the current mortgage rate, so it could settle down at around 5.5%.
Lawrence, in terms of this weakness that we are seeing in the housing market, I guess how long do you expect that to persist before we start to see any improvement?
I think it's 1 or 2 additional months of low sales activity because, as you mentioned, mortgage rates have fallen for 5 straight weeks. And mortgage rate is always the key leading indicator. And all that will lead to buyers steadily coming back to the market. And if the mortgage rate decline further, as I expect towards next year, then there will be greater number of people entering the market. The key question is whether there will be sufficient supply. Because again, we had the housing shortage, and then housing shortage does not appear to be at the present, but when the buyers come back, we could again face that issue.
All right, we're looking forward to next year, and you're showing us the top markets for real estate next year: Atlanta, Raleigh, Dallas, Fayetteville, Greenville, South Carolina, all pretty much concentrated, relatively speaking, in one portion of the country. What is it that connects these two? What's the common thread among these top markets you see for next year?
2 factors. Affordability. They are relatively affordable, definitely compared to, say, California market or New York. And the second factor is much faster job creation compared to the rest of the country. So a combination of affordability and strong job creation will lead these markets to outperform.
Are these markets that investors are eyeing right now?
There is a more than usual investor activity compared to other markets. Now, the investors are not interested in million-dollar home. They're interested in those starter homes, which they get converted into rentals. So the investors are present, but I think the first-time buyers, they're eager to get into the market. And given that the prices are relatively affordable, if the mortgage rate goes down, continuing job creation in the local area, boom, you have the buyers coming in.
Lawrence, you just mentioned rentals there and what investors might potentially be doing with some of these homes that they are scooping up. When it comes to rent prices, we certainly have already seen a large jump this year. What are you anticipating that we'll see next year?
We have the record high, or I should say 40-year high in apartment buildings right now. So single-family home construction is down. So the home builders are suffering. But the apartment building is at a 40-year high. All this excess supply coming into the rentals market will calm down the rent growth. Rents have been rising faster than 10% in some of the private sector data. Now, CPI has not yet incorporated those information, but now we have turned a corner. Rents are rising, but at a slower rate than before, and this will contribute to actually falling overall CPI, but also the fact that the renters will get some relief next year.
All right, Lawrence Yun, always great to have you. Thanks so much for breaking down the latest when it comes to housing. Well, coming up, the Consumer Financial Protection Bureau ordering Wells Fargo to pay a pretty hefty fine because he shares under pressure here, off just about 1.6%. More on that when we come back. Time for our triple play. Three stocks that we are watching in the final 30 minutes of trading. We have Brooke DePalma on set here. We are talking Wells Fargo, General Mills, and Tesla. Let's kick it off with Wells Fargo, ticker WFC. Now, the big bank reaching a $3.7 billion settlement with the Consumer Financial Protection Bureau. So this agreement includes a $1.7 billion civil penalty with fines tied to mismanagement of mortgages, car loans, and bank accounts. Now, CFPB Director Rohit Chopra saying in his statement statement that Wells Fargo's, quote, rinse-repeat cycle of violating the law has harmed millions of American families. Now, he called this agreement, quote, an important initial step for accountability and long-term reform. So yes, certainly, Brooke, a step here for Wells Fargo, but lots of talk about future fines and the implications, what that could mean for Wells Fargo down the road.
Yeah, well, Wall Street seeming to agree with that statement there. A Jefferies analyst noting, while we do not see today's action as having a direct read, though, to the asset cap and potential removal, we would take today's announcement as a sign of positive progress on moving toward that ultimate goal. Ultimately, Wall Street here seemingly unbothered, dare I say, shares down nearly 2%, but upon the initial announcement, only down about 1.5%. Now, my play here, General Mills, the company posted better than expected fiscal second quarter results on both the top and bottom line and raised its full year 2023 outlook for net sales, adjusted operating profit, and adjusted EPS growth. Now, the positive results were brought down just a bit by its pet business there. Sales remained flat and volume decreased 11%. General Mills does expect to get back to double-digit net sales growth on pet in the second half of its fiscal 2023. Now, it's important to note here that JP Morgan said that it downplayed Blue Buffalo production issues as retailers grew frustrated with what they said is the inability to consistently supply demand. And so therefore retailers went to other pet brands to then fill their shelves.
Yeah, and I was reading through the commentary through the conference call, and the CEO spoke to that and didn't hide from it, said supply chain disruptions remain well above historical averages, and we're not forecasting return to pre-pandemic levels of supply disruption nor customer service during this fiscal year. So not hiding from the problems. We haven't heard just about how blunt it has been in terms of supply chain disruption until that conference call. Certainly interesting from the CEO. All right, my play is Tesla, the stock desperately needing a fresh charge. That did not come today by any means. Evercore ISI slashing its price target by $100 a share from 3 to 200. The note saying China stalled growth remains, but with global backlog winding down, investors are also revisiting demand assumptions for the first time. That's not all. Evercore also wants to see the Tesla Model 2 because, quote, China and the EU desperately need a smaller, cheaper model. That's not all. Daiwa Capital Markets cutting its price target to 177 from 240. Oppenheimer downgraded the stock on Monday, and look at that chart. It's remarkable. Shares down 6.5% today, 15% in the last month, 30% since the Twitter takeover, and down more than 60% this year. It is an astounding fall from grace for the world's most valuable automaker.
It certainly is. Right now, it's going to be interesting to see how Tesla is set up in the new year, what adjustments, if any, they are going to make. Analysts becoming more and more critical of Elon Musk and everything, all the time that he has spent on Twitter. It seems like from his most recent Twitter poll, also the most recent reporting that we'll get into in the next segment, that he looks like he's going to step down as the CEO of Twitter, maybe spend more time at Tesla. We've talked to Dan Ives of Wedbush on this program a number of times, and he's grown more and more critical of Musk and the I guess imposition that he is posing now to so many shareholders. Policymakers are also weighing in too.
But this Evercore note makes clear it's not just the Twitter distraction. Yeah. It is far from that. There are demand issues, there are China issues, there are product issues. There's got to be more than the Twitter hangover for being down 60+% year to date, Shauna. A lot more.
Well, I don't know. I think most of the decline recently has been because of Musk, and you can see that reflected.
You might argue half of it.
I would argue probably more than over half of it. Half of it, yes. Okay. I do think that there are other issues facing Tesla right now, but I do think the biggest issue by far, and you could see it plainly in a lot of these analyst notes, and I know many of them
we should let you back
other challenges.
And just to jump in there.
It is, I think, by far their biggest issue.
Just to jump in there, though, we also did know that last week Musk sold 22 million shares of Tesla. Now, that's about $3.6 billion. Also, as you noted, Dan Ives, he said that it seems like Musk is simply using Tesla as a way to sort of ATM machine to fund Twitter. And so the distraction is there for Musk. And and Wall Street not denying that either.
Yeah, certainly is. Shares have been hurt pretty bad, to say the least, this year. Well, speaking of Elon Musk, we are far from dumb here because Musk is reportedly dumb and neither of those. All right, let's take one more shot at this. Musk is looking to find a successor at one of the companies that he runs. We just gave away that tease in the last segment, but also the auto industry executives thinking that rivals are starting to catch up with Tesla. A number of challenges here for Musk. We've got all those details when we come back. Elon Musk reportedly looking for a new CEO for Twitter. Now, it comes amid a report from Bloomberg that says that the FTC is stepping up its investigation into Twitter's privacy and data security practices. Our own Dan Halley joining us now with the latest on this. And Dan, what can you tell us just in terms of the implications here, what it could mean for Musk and his future with Twitter?
Yeah, there was that poll that we had seen that Elon Musk had put out that asking if he should step down or he shouldn't step down as Twitter CEO. It came back that he should step down. And now it doesn't look as though he's going to follow through with that immediately, although he has said that he is looking outside outside for a new CEO to take over. This is something that is being reported by CNBC. And, it goes along with his general plan that he wanted to not be a long-term executive at this company. He really wanted to take it over and then probably sit on the board while there was a different chief executive in his place. So, whether or not we'll actually see anything happen in the next couple of days, that's really up in the air. Whether or not it's related to the poll, according to these reports, he was already looking for a new CEO prior to the poll's launch. But if you follow his Twitter account, which I do, he's been talking about the poll, kind of insinuating that there may have been bots involved in trying to get him to have it say that he should step down as CEO. He had retweeted another poll that had said that he should remain as CEO from a survey that was done. And he's kind of, having this back and forth with people over whether or not he should step down, and the impact on Tesla, as you guys were just discussing during Triple Play. And I think as far as the company itself goes, is this just doesn't seem to be benefiting him. It seems to be a larger headache overall, though he'll continue to tweet out positives, and he still continues to plug away at that so-called Twitter files that he's been discussing. So I don't know exactly when he will make the move to step down. He didn't want to be there for more than a few months. So, he did purchase everything in October. We could see something in the next couple of weeks, if not sooner, though, considering that he does say that he sticks to those poll numbers.
He's also been tweeting out the many changes to the platform, which are not getting attention, of course, because of all the distractions. What is he doing, in effect, to change Twitter as we know it?
Yeah, he has the new Twitter Blue that went out. He raised the price on that for if you purchase on iOS because of that 30% fee that Apple has. He has obviously tamped down the rhetoric against advertisers who weren't joining the platform or were nervous about joining the platform with him, in particular because of his stance on speech. He had that kind of dust up with several journalists who were reporting on the Elon Jet account. And so, there's been different changes to Twitter. He says he's not going to make changes, unless people agree with it. He'll have polls. Then there was a discussion of whether or not he'll run those polls through only Twitter Blue subscribers and not the general users. So, there's just a lot going on, to say the least. Trying to get a real through line as to, where his head's at for the company. It's incredibly difficult to do something like that. But, as you said earlier, the FTC is looking into it as well, and whether or not they can, Twitter can continue to abide by that consent decree over privacy. So there's so many things that he has to deal with. And, as you just talked about, Tesla.
It is all sipping from a fire hose. Dan Alley, thank you so much. Appreciate that reporting. Auto executives around the globe are pumping the brakes when it comes to expectations for EV adoption. In a recent survey conducted by consulting and accounting firm KPMG, the median expectation for EV sales in the U.S. by 2030 fell from 65 last year to 35% in this year's poll. That would fall well short of President Biden's goal of half of all new vehicle sales in 2030 to be fully electric. Praz Subramanian here with more on this. Wow, what has caused that number in your estimation to fall so dramatically?
It's a big part of it, I think, is they're concerned about pricing in terms of component prices, and also things like EV adoption rates. They think that they're not going to be as strong as they believe. Higher rates too, right, are affecting the kind of adoption of
gas prices coming down.
Exactly.
I would think would factor in there as well.
Yeah, so you have these EVs that are already kind of expensive, hard to get the critical materials you need for the batteries and things like that. And in places like India, Brazil, and even Japan, they're not seeing the EV adoption kind of happen fast as soon as they think it would be because of various reasons. Japan is interesting because the CEO of Toyota is kind of pumping the brakes also on, talking about there's a silent majority out there of auto execs who don't think this is going to happen because of, maybe the governments are too aggressive with their kind of deadlines for making this happen. So that's why there's some sort of ambivalence toward that transformation right now with these auto execs.
Yeah, there certainly is a lot of uncertainty. And then also what I found interesting in this survey, Pras, was the companies that the auto executives think are going to lead the EV market, the battery EV market in 2030. Tesla, a year ago, was by far the leader in this space, and certainly a number of the competitors, we have it up on the screen, really closing the gap. And it looks like Tesla's grip here could in fact be slipping a bit.
Yeah, for sure. 233 execs thought 419 thought Tesla would be number one, and then now it's down to 223 by 2030. One other thing that's not on there is Apple actually was number 4 on that list, and then they went up from number 9 in 2021. So it's interesting to see Apple kind of coming in out of the blue. We don't have a car yet.
They don't have a car.
Yeah. So what's that going to be like? Borrow a platform from somebody, put their software in there. But the Apple car is very concerning to a lot of these execs.
Yeah, certainly you can never count out Apple. All right, well, Pras, while we have you, the Treasury Department is delaying a tax credit guidance for EVs until at least March. It certainly sounds like some good news for some of the EVs that maybe weren't initially going to be eligible for this.
Yeah, you know, GM and Tesla, two in particular, were kind of phased out of that credit. And now with the new initiation of it with the IRA, they're going to get back into it starting on January 1st. But the big part of it is half of that credit has to do with critical materials sourcing, right? If you don't have 40% of the materials from the U.S. or trade partners, you lose half the tax credit. But Treasury's delaying that guidance until March, maybe even later. And so that means that GM and Tesla get not only half that they were going to get originally, they're going to get the other half too. So they're going to get $7,500 for their vehicles, like the Chevy Bolt, like the Tesla Model Y and Model 3 that qualify from a price point of view. They're all going to get the full EV tax credit starting January 1st. So that's a big deal. And also GM, we got the Equinox coming, we got the new Silverado coming. They might qualify too.
Feels less because of all these price increases we've heard about constantly, including the Ford F-150 Lightning, which has gone up dramatically. Pras, thank you, my friend. Great stuff. All right, coming up, the triple-demic forces Walgreens and CVS to limit the amount of children's pain relief medication you can buy. We'll add the details after the break.
Walgreens and CVS are limiting the sales of children's medications amid this winter's triple-demic of viruses. Yahoo Finance's Anjali Kamlani joining us now with more. And just in terms of the restrictions, what does everyone need to know?
Well, Shauna, unfortunately, we've gotten to the point where we actually do have some restrictions from these major retailers, including CVS and Walgreens so far. Walmart and Amazon, no word yet, as well as also Kroger add to that list where there are limitations. So CVS, 2 pain relief medications per customer. This is only for pediatrics. Walgreens, 6 in total. Kroger has separated it between pain relief and cold and flu, which is also seeing a shortage, as we've reported on this show, for the past several weeks. And we know that shortage has also been sort of seeping over, if you will, into the adult category. I did reach out to the makers of children's Motrin and Tylenol, that's Johnson & Johnson, as well as children's Advil, because those are the 3 that are in shortage. Johnson & Johnson got back to us saying that, quote, "We continue to experience high consumer demand driven by an extremely challenging cold and flu season," but they noted that they're not experiencing the shortages that have been reported in the stores and have been increasing supply and producing 24/7. We know that the White House is aware of this. Recently, Dr. Dr. Ashish Jha in an interview saying that, confirming that supply is up, but just the demand of flu, RSV, and COVID-19 circulating at the same time, affecting this population, having that similar effect on demand.
And I know I personally firsthand have been having a tough time getting my hands on some of those medications, so hopefully supply is boosted very soon. Anjali Kamlani, thanks so much. We're just about 5 minutes here until the closing bell. Still looking at gains across the board. Dow up 123. We'll be right back. Just minutes away from the closing bell, Jared Blickery has a closer look at some of today's big movers. Jared, what do you have for us?
That's right, a bit of green to start the week, and let's dive right into our heat maps. I'm beginning in the EV market, and we're going to actually have to sort by performance. So we can see fuel cell, that is down 18.5% today. And this comes as the EV and power and carbon capture company posting fourth quarter revenue of $39.2 million. That's missing estimates by $6 million, and also reporting a wider than expected EBITDA loss of $36.1 million. Now, the stock, which became a day trader favorite over the pandemic, is back to November 2020 levels. And let me put a 3-year chart so we can see this exactly. If you draw a horizontal line there you go back all the way to 2020, and given up half of its value this year alone. And we can see that in the year-to-date chart. A lot of these other EV stocks not faring as well. So let's turn the corner here, and we're going to go straight to some of our miners. Now, I haven't talked about gold and silver miners in a bit, but a lot of these names have been perking up. So let's start with GLD. Now, this is an ETF that tracks gold overall. That is the yellow metal. And you can see over the last 3 years, basically treading water, going sideways here, trapping a lot of investors both to the upside and to the downside. Silver kind of in the same situation. But let me just sort by performance here and show you what's happened over the last 3 months. A lot of these names quietly have picked up here. SLV is the silver ETF, kind of the complement to GLD. This is also over a 5-year time span, and you can see it has raced up quite a bit more over the last 3 months than GLD. So silver up 25%, gold up about 9%, and some of these miners, which are more heavily levered to the space than the actual futures, those are up and down even more. Now, want to finally move on to Congo, which is pouring water, cold water over weed stocks. And let me see if I can find this here, our weed board. Now, weed stocks in particular have suffered over the last month. This is over the last last 3 months. Let me just change this to a 1-month view. Now, that safe banking bill that might have been added to the latest spending bill that's getting shoved through Congress right now, guess what? That didn't happen. But Dave, I got to ask you, did anybody think that was going to happen anyway?
Not anyone that watches this show. There should not have been optimism baked in, pun intended, to these stocks, because there should not have been optimism over safe banking, not until we get a different Congress, and that's not going to happen for a couple of years. Look, the only way to get it through was through a spending bill, tuck it into something else. As a standalone piece of legislation, I think it's been passed 7 or 8 times through the House. It is not going to get passed through the Senate. Republicans have repeatedly squashed that notion. I don't know what the optimistic view is for cannabis stocks. I think we're going to have 2 CEOs on later this week, but down between 50 and 75% year to date. Jared, thank you. Here now your closing bell for Tuesday, 20th. Ladies' Day on Wall Street. We got some green numbers snapping a 4-day losing streak. The Dow up 92 points. The S&P just barely in the green, but we will take it and look at the Nasdaq by the slightest of margins again with the bleak outlook we've had. My friends, we will take it. For a closer look at the broader markets, let's bring in Barrett Asset Management Chief Investment Officer Amy Kong. Amy, nice to see you. Look, they're very slight gains, relatively low trading, but we'll take it. What do you make of it?
Hi, guys. Thanks for having me. I hear you. It's one of those days where we'll take it after 4 or 5 very tough sessions. And it's really just perhaps waiting for that next data point to come out, which could possibly be PCE numbers coming in on Friday. So perhaps that volatility might start to go up higher by the end of this week.
Amy, what are you expecting to see from that print? And then looking out just in terms of how we will likely trade over the next several weeks, what are you expecting there?
Sure. I think the PCE number could come in very similar to what we saw with the CPI numbers, meaning that there is this peak inflation trend forming. And that hopefully could support the argument that the Fed will likely slow down, not stop, but slow down into 2023 in terms of its interest rate hikes. Coming into 2023, this Santa Claus rally that we've all been waiting for, the chances of that is dimming a little bit. Although I'm not surprised, I wouldn't be surprised, let's call it, to see perhaps the last trading days pick up a little bit. We tend to see that. But then, of course, as we go into the new year, there could continue to be volatility as new calendar year. People could be taking some gains off the table again. And so again, that volatility could pick up as we enter the new calendar year.
And so just to be clear and zero in on what you think the Fed will do, Amy, you think 225s and a pause?
Yeah, I think, right now I don't think a pause is in the cards yet for the next couple of FOMC meetings. Right now, CPI has come down, but it's still very high on an absolute level. And so if that continues, meaning the trend continues to soften, we could see CPI and the Fed funds rate start to meet somewhere between that May to July period. And that could be somewhere between 3.5% and 4.5%. So I think the next couple of FOMC meetings, I think they'll continue to hike. I think 50 basis points may be in the cards for January. We'll have to see what the next couple of CPI numbers come out with.
Amy, there is some concern out there that the Fed has been too aggressive already, that it will continue to be too aggressive, and then the implications from that. Are you at all worried about that aspect of this equation yet?
I certainly am. I think you raise an excellent point. And one of the biggest risks on our laundry list of worries, if you would, is Fed policy error. The Fed uses data points that are somewhat lagging to make its financial decisions or monetary policy decisions. And while they want to fight inflation, I think it does take time for past rate hikes to really trickle into the system. And the past couple of rate hikes have been very aggressive. So I do think they need to recognize that. So while at the same time it is tough because you have to balance the fact that if you were to pause or send the wrong message, you can send the markets into some kind of tailspin, and you want to avoid that as well. So I think maybe that 25 to 50 basis points rate hike going into the next several meetings makes sense. But I think pausing without seeing the inflation data points, I believe that could be an error.
And if they do make that error, where would it be reflected? Where would we see it first?
You'll see it both in the stock market and the bond market. I mean, the bond market is sending a message to the Fed right now that they are probably too aggressive. And you can see that with Fed funds futures. Bond market traders are expecting rate hikes by the back half of 2023. And so there's definitely going to be some reflection there. The stock market will also be very responsive in the sense that, you know, they're hinged on every word Jerome Powell says. And so any error or any, confusion, if you would, in terms of its language, I think the markets will definitely show it through volatility.
So, Amy, what does all this mean from an investor perspective and what people should maybe be prioritizing or buying at this point?
Sure. I think from a stock market perspective, we don't think that it pays to be overly exposed to the stock market at this point. So we are not allocating any new dollars to stocks at this junction. Where we are putting that money is probably in the bond market, and we are starting to see yields pick up. And we're also starting to expect yields to peak sometime in Q1/Q2 of next year. So where we have been hiding in very, very short-term treasuries over the past 12 months, going into the next 12 months, we're actually looking to elongate duration in our portfolios, meaning we're looking to probably lock in some rates, perhaps up to 5 years in maturity, so that, again, if the recession does happen and the Fed has to actually reverse course, we're actually locking in some pretty decent yields going into the next couple of years.
And what's your prediction for equities moving forward in 23?
That's a tough call, right? So, you know, all throughout 2022, we've had a PE contraction, macro conditions causing that, the Fed causing that. And going into 2023, you know, if the P part of the price to earnings ratio is not to move higher because of macro conditions, it's really reliant on the E portion of the PE. And earnings could be at risk going into next year, considering that many of the companies we follow have not yet provided guidance. So that actually would be an important hurdle for us to get through, that we'll obviously see more data in January into February in the next earnings season. And we do expect those numbers to come down. So our outlook going into 23 is somewhat cautious, considering that the earnings portion is likely at risk.
Amy, when it comes to the consumer has in fact been relatively resilient when you compare just in terms of the deteriorating economy, the higher costs, everything that the consumer has been facing up until this point. What is your outlook there just in terms of how much the strength of the consumer might be able to offset some of the weakness that we're seeing more broadly speaking in the economy next year?
Excellent question. I think you're right. The consumer has held up very well. A lot of that is based on two main factors. One is just excess savings from the pandemic, right? The government was basically shoving dollars into our pockets in some form or fashion. And that's is somewhat waning a little bit, especially with some of the lower income earners. I think the other aspect that's been holding up well is wage inflation. It's still hovering around that 5% level and has been able to offset some inflation that we're seeing in the food and energy, at least for the first part of this year. And so overall, the consumer has been holding up well, but we are starting to see cracks. Retail sales numbers are softening. That is a reflection of consumers turning more and more cautious as we head into 2023. And in general, the savings rate as a percentage of disposable income has also come down quite a bit. So what that means is the inflation part from wages has helped, but then people are saving less to, again, make up the other half. And so what we're seeing is savings rate is now down to 2 to 3%, which is somewhat low compared to what we've seen in the earlier parts of the year or even pre-pandemic, which had been somewhere in the high single digits. So I think the consumer is still holding up, but we're starting to see some cracks in the system.
All right, something to worry about here as we enter the new year. Amy Kong, always great to have you. Thanks so much for joining us here this afternoon. Well, coming up, FedEx shares moving lower, off just about 1%, releasing earnings. We'll have more on that when we come back. FedEx shares moving lower here, off nearly 1% after hours. Jared Blickery has the earnings results for us. Hey, Jared.
Hey there. Well, they're getting their costs under control. That's the bottom line. And I think that's why we're not seeing the stock down more. It's only one quarter after they were down 21%. That was a record for FedEx. But here are the current quarter results. Second quarter adjusted EPS coming in at $3.18. The estimate was for $2.80. That's 38 cents lower. Adjusted operating income, a beat. 1.21 billion. The estimate was for lower at 987.9 million. And then the adjusted operating margin, that's a 5.3% for the second quarter. The estimate was for lower at 4.15%. Here's where things get a little bit negative in terms of the guidance. Let me just see here. FedEx second quarter revenue, they're expecting that to be 10.86 billion, whereas the estimate was for 11.32 billion. So a little bit of a disappointment there. Full year adjusted EPS, they're saying $13 to $14, whereas the street's saying $14.14. So their range a little bit lower than the street estimate. Also, they've identified, and this is getting back to their main thesis of cutting costs here, they've added $1 billion in cost savings beyond their September forecast. And one other stat here, FedEx is seeing full year CapEx at $5.9 billion. They previously saw $6.3 billion. The estimate was for $6.27 billion. So the cost cutting looks to be exceeding Wall Street expectations, while their guidance in terms of EPS and revenue just a little bit short, guys.
All right, Jared, thanks so much. Let's talk about what all of this means here for the company. We have John Eade, Argus Research President and Director of Portfolio. John, it's great to see you. So just your initial thoughts on this report. So guidance looks like that's coming in a bit light, but FedEx taking even more action in terms of trying to cut their costs even further than we had initially expected.
Right. I think this is FedEx trying to get back on track after the awful quarter they had in their first quarter when they had withdrawn all of their guidance. So now at least they're providing some clarity and some transparency to investors, even if it's a little bit below what the street had expected. Our estimate was for $13.50 in EPS this year. So we're right in the middle of that range.
Margins were something everyone was watching. What do you make of that side of the earnings report?
Well, FedEx really comes up short on margins compared to other players in the industry, like UPS, right? FedEx delivered a 5.3% operating margin, something like that. UPS is 12.5% to 13%. So for a very similar business, UPS is able to generate a lot more profit than FedEx. Now that can be an opportunity for FedEx, and if they're able to take these costs out of their cost structure, you could see much sharper earnings growth going forward. But that remains to be seen. I think that the new management is still being questioned on what can actually get done.
Yeah, John, when it comes to the cost-cutting plan, we know that FedEx's now 2023 CapEx spending forecast was reduced by $400 million. Just your assessment of the cost-cutting plan so far and maybe what FedEx needs to continue to do moving forward.
Well, it's partly cost-cutting, but it's also cash shifting. Mm-hmm. When the new CEO came on board, there was an activist investor alongside. They changed the compensation structure to pay more on shareholder returns. They increased the dividend 50%. They set all these aggressive return goals for 5 years, and then everything blew up in that first quarter. So I really think they're scrambling, and they're probably setting the bar pretty low. You mentioned the street estimate was a little bit over 14. Mm-hmm. There's a good chance that FedEx does better than that by the end of the year. But right now, I don't think they want to overpromise and underdeliver, and they're trying to get back in the good graces of Wall Street. And it's probably going to take a little bit of time.
And you mentioned management. Look, it's not easy replacing a legend in Fred Smith. Just ask Mac Jones, the Patriots quarterback. What do you make of Raj Subramaniam and the job he's done there? And can he really cost cut his way to a win?
Yeah, that's a great question. And he is a longtime FedEx exec. And you can contrast that with UPS, which went out to Home Depot, which is one of the best managed companies in the S&P 500, and brought their CFO over. And she's done a great job of improving profitability, growing the dividend. And I think it might be a little bit easier for an outsider to come in with these kinds of goals than from somebody who's worked side by side in all of these areas that now are facing pretty sharp cuts.
John, when you take a look at these quarterly results here, Raj Subramanian saying that second quarter results were constrained by continued demand weakness, especially what the company was seeing at FedEx Express. And I bring this up because that portion of the business is FedEx's largest. It's also its best known business. What do you think this signals, not just about FedEx, but maybe more broadly what we're seeing industry wide?
Well, yeah, I haven't been able to drill down to the volume numbers yet, but I'll tell you, last quarter, their volumes were off 11%, and they were still able to generate revenue growth, and that's because they were pushing through price increases. Well, I bet the volumes were a little bit softer here in this latest quarter, and inflation is coming down a little bit, so that's going to make that top line growth even stronger, and the company is going to be more dependent on widening margins to deliver EPS growth and EPS targets. But I think that lower volume is something we're going to see when the trucking companies report, when the rails report, right? That's just where we're headed in the overall economy right now.
Indeed. All right. Thanks so much, John Eade. Great stuff. Argus Research President and Director of Portfolio. Appreciate you coming on. Okay, coming up, Nike's trading on earnings. We have the numbers for you and analysis right after the break. All right, an earnings alert. Nike shares up just over 1% after reporting. Josh Schaefer is here with a deeper dive into the numbers. Josh, what are we seeing, buddy?
Yeah, Dave, a little bit of a mixed picture here for Nike. We've seen the shares go up, down, and now back up again. So let's get into the numbers here. We got Q2 revenue for 2023 coming in at $13.32 billion. That was versus $12.58 billion estimated. And then when you take a look at EPS, you got EPS coming in at 85 cents. That was versus 65 cents. That was estimated for that. Now, a couple key metrics that might have been sending the stock down a little bit here, Dave. When you look at direct-to-consumer sales, that came in at $5.4 billion. That's versus the estimate of $5.64 billion. We know that's a big growth metric for Nike. Inventories also up 43%. Year over year, another number we've been watching. Notice that number isn't changed much from 44% last quarter. Greater China revenue comes in at $1.7 billion. That's versus an estimate of $1.81 billion. So came in lower than estimates there. And then you have gross margins coming in at 42.9%. It beat expectations, Dave, which were 42.1%, but down on a year over year basis. So Nike's still taking a hit at those margins. One thing that I think is going to be interesting to hear later on from President and CEO John Donahoe in the call is going to be what happened with these sales. The quarter ended November 30th, so we got a little bit of Black Friday. Nike had more sales in November this year than they had last year, trying to get rid of a little bit of that inventory. Yeah. How'd that go for the company? Hopefully we get a little bit more clarity in the next hour or so.
Markdowns was clearly the theme for Nike as they try to work that inventory mess out, but it appears they have not. Josh Schaefer, thank you. Deeper dive into Nike's earnings. Let's bring in Adrian Yee, Barclays consumer discretionary analyst. Nice to see you. What do you make of the report and the fact that shares up just a bit?
Yeah, so the expectations were extraordinarily high going into this. The company had marketed some right after their last earnings when they had lowered numbers. What's really interesting as we were talking to investors going into the print, it was all about this inventory number. Yeah. So understandably, the DTC, came in a little bit shy, but it means that the wholesale is actually pretty healthy for the spring selling season. So that's actually net positive. And all the metrics through and through kind of beat expectations. As I said, the expectations were high, and the only one that missed is that inventory number. I think the question mark is, how does that bode for gross margin guidance for the next quarter? Is it similar to the sort of down 300? And there's still more pressure on that GM number to come from kind of clearing through this apparel inventory. Remember, they had said it would be done in 2 quarters. So they do have another quarter of kind of, benefit of the doubt, so to speak, to get through this inventory.
Adrian, is that realistic, the fact that they will be able to work through that backlog and inventory in such a short amount of time? And you mentioned gross margin there. In terms of the guidance, what are you more specifically looking for over the next quarter or two?
So the inventory number, right, that's kind of sitting at 9.3 billion. The good news about that is that we always look at sales to inventory spread, the growth, right? So sales was up very nicely, right? Significantly more than the 4% it was up in the prior quarter. And inventory is pretty much up the same, 43% versus up 44% at the end of the prior quarter. So they are making headway in terms of selling it through. The other thing they told us last quarter, and we want to hear more about, is cutting off the manufacturing at the source. So that's how you get rid of it from sort of the seed, right? The beginning of the whole process, as well as purging it through the channel on the outer end. So if you're working at it from both ways, I'd say probably the next quarter, and we've heard this from DKS, who had recently reported and told us that they took a really, really aggressive stance on that apparel merchandise in their third quarter and will continue to do so into the fourth. So by the end of the next quarter, we should see some material progress on that inventory, in my opinion.
How significant do the markdowns reflect on this report, and do you expect them to, in fact, reflect on the next?
So given that the inventory is still sitting at these levels, there's only 3 ways to get out of this heavy inventory relative to sales. Either sales continues to go up, this huge double-digit number, and mind you, the promotions are definitely helping move those sales. You purge it through the margin, right? You promote it through the P&L, or you start ordering less. And sometimes that does kind of slow down the cadence of sales over time. So only one of those ways is a super healthy way to do so. But I think at this point for longer term investors, they're really looking beyond some of these, what we want to call transitory things, right? The inventory ups and downs of the supply chain, purging that through the gross margin. And remember, this was isolated to an apparel issue, largely in North America, EMEA B. So that's always a good signal as we go into the next quarter.
Adrian, what do you make of the numbers coming out of China and the performance that we have seen from Nike in China? Because the most recent numbers, revenue for the second quarter, coming in a bit light here, 1.79 billion. The street was looking for 1.82 billion. So not a miss by a wide margin, but just in terms of what that signals, because the fact that COVID restrictions are being lifted, maybe you're a little bit more optimistic about what we could see from China over the coming quarters.
Exactly. So what we want to hear from them is the cadence at the very tail end, the last few weeks, right? Kind of as things started to loosen up. After the quarter, things really loosened up. So we want to really hear what's happening in December quarter to date. I think that will give people a big sigh of relief as we go into calendar 2023. Remember, thematically, investors are looking for China reopening stories. And if we recall kind of where Nike sat before their PR event in March of 2021, they sat at about 21% of sales in China. They now sit at about 15%. So if we are at the low and people are convinced that things are reopening, then Nike looks like it's a pretty attractive China reopening play.
Adrian, I know you said you wanted to hear a little bit more about inventories. What else are you going to be focusing on this call that's going to get underway in just a few minutes?
So for sure, the inventory piece of it, the sustainability of this, up 17, the street was looking for kind of up low double digit, as was the company's guidance. So really kind of how sustainable and how much of those sales, that huge North American beat was driven by promotions. As we know, when you have a really good brand and you're selling it at, haven't before seen promos since the pandemic started, it's going to get a reaction. So really what we want to hear is how sustainable is that, up, low double digit if they're going to guide again for that, the inventory, China for sure, and then the strength in wholesale. We know that last spring, a lot of the retail partners were under inventoried. So it's really nice to see kind of the wholesale piece of it, especially as they now have that footwear piece of it that is back in stock.
Adrian Yee, great to get your perspective here of Barclays. Thanks so much for joining us this afternoon. We look forward to having you back, hopefully next quarter. All right, coming up next, we're going to stick here.
We're going
to do it right now. Why wait till later? Something you can do right now. Inflation. It's not only changing Americans' buying habits, but also our expectations. According to a new survey, data from the New York Fed found that the average lowest wage that respondents will be willing to accept for a new job is up to $73,000, 667. But when you break it down by education, college grads, they want just over $92,000. That's up more than $8,000 from a year ago. Those without a college degree expect around $59,800, which is less than the $60,000 a year, $60,100 a year ago. A little bit confusing with all those numbers, but the big takeaway, Dave, is I think many workers are demanding a higher salary. I don't think that's a huge surprise to anyone, given the fact that costs have been rising now pretty significantly from where they were a year ago. If you're paying more in almost every aspect of your life, I think you're going to, and you should, want to be compensated more fairly.
Employers should expect that if they're not giving their employees a raise right now, they are de facto giving them a pay cut. That's just the reality. That is the economy we are in. We're talking about 7% inflation. So if you're not keeping up with that, which wage growth overall is not, the Fed wants to tame wage growth, which is about 5%, I believe at last check. Significant, but not keeping up with inflation. It's an interesting moment we're in when you bring in the Fed into that conversation, because they want to tame wage growth, but it's not keeping up with inflation. What will happen with this labor market? Will it break that dynamic in the months ahead? Hard to know, but that's...
And also many employees have the upper hand in all of this.
Right
now they do, just in terms of the labor shortage, or simply are not as many workers out there in terms of what is needed. So of course, if the economy continues to significantly weaken, we could see that balance shift pretty significantly. But at least at this point, employees have the upper hand. They're able to demand those higher wages. We'll see, though, how long that's going to be the case.
Yeah, and that college degree number, you always expect that to continue to climb, because the cost of college is dramatically increasing just about every year. So naturally, you're going to see that expectation continue to rise with the rising cost of college.
Yeah, certainly. All right, well, coming up next here on Yahoo Finance, BlackBerry shares have been cut in half this year, and that's bad news for those who bought it as part of the meme stock trade. We will tell you about one of those investors. He's going to join us on set right after the break.
The turn of the calendar usually calls for some portfolio reshuffling. And in a year where broader markets have slumped, certain sectors have fallen even further. Meme stocks, once the darling of the day, traders in 2021 have had little to celebrate this year. AMC, GameStop, and BlackBerry each off more than 50% this year. So what happened to those investors that bought high only to watch their shares tumble? One of those Wall Street bet hopefuls is right with us now, our very own senior columnist, Rick Newman. You bought some BlackBerry stock back in June of 21. Why?
Sazi just ripped me on this one. He said, dude, what were you thinking? And I, back in June of 21, GameStop and AMC had already spiked by then. And everybody's talking about what's going to be the next meme stock. So I thought, I'm going to try this out and see what happens. I don't mind experimenting with investments at a small scale because sometimes you learn more by losing money than you do by making money. And I certainly learned because I lost a lot of money on BlackBerry.
My
investment, I put in $2,500 in BlackBerry when it was at $14. Now, I'm glad I didn't put more in. I'm not starving because BlackBerry has been down by about 70%. But as I'm looking at what's happening with this, and we are writing about how the meme craze is over, and you look at what's happened with the stocks, they're almost all back to pre-meme levels. BlackBerry never memed after I bought it. It was a meme stock that didn't meme. So I ended up losing about $1,700. And I don't have to care about BlackBerry anymore. I don't have to look at that dog in my statement.
But you say, Rick, that you learned. What did you learn? And typically, let's just be honest, this is how millions of Americans, in fact, do make stock purchases today.
So I knew that this was a speculative bubble when I bought BlackBerry. I didn't even look at the balance sheet. I didn't look at stock recommendations. I just wanted to see if it would work. Getting into a speculative bubble, and all the pros were correctly saying this isn't going to last. People are going to lose a lot of money. That mostly has happened. But I knew that. I expected that to happen, and I just wanted to see can I get in before other people so that this will go up and I'll just sell it to somebody else, and the guy I sell it to is going to be the one who loses the money instead of me. Well, I turned out to be the schlub. I was the one who bought too late. So one lesson is, if you're going to get into a speculative bubble, get in early. And probably the better lesson is just don't get in the speculative bubble at all.
What you need to do is start a podcast and pump that stock up. What is the Wall Street?
Let's talk after the show, man.
No pump and dump scandals. I'm not recommending it. What are they talking about now on Wall Street Bets?
I went to look. Are they still talking about what the next meme stock is going to be? This is the Reddit channel. No, they are fretting about what's happening at Tesla, what's happening at Twitter, because a lot of them have Tesla stock and they're Elon Musk fans, and Tesla has what is Tesla down 60% this year? I mean, it's a wipeout. And there's a lot of moping about a very gloomy Christmas because everybody lost a lot of money.
Well, at least they've got crypto. Oh, wait. No, they don't.
Yeah, the everything rally is the nothing rally.
Wow, it is a tough year for those folks, as well as you, but apparently you have it to lose, so that's a good problem to have.
I'll just add one little thing.
Yep.
I bought an energy ETF when oil was at $50. Oil went to $20. It seemed like a really bad bet, but then oil went to $120. I sure did. I didn't sell that at the bottom.
Well done, sir. And that's the kind of advice we need. Rick Newman, senior columnist. Coming up, we'll talk to one small business owner who's advocating for an increase in the minimum wage. He tells us why next.
More than 20 states are set to increase their minimum wage at the start of the new year, and the proposed Raise the Wage Act in Congress aims to increase the federal minimum wage to $15 an hour. Let's talk about what this could mean for small businesses, the impact there. We want to bring in Dave Titterington. He's the owner of Wild Bird Habitat Stores and also a member of the Businesses for a Fair Minimum Wage Network. Dave, it's great to see you here. So let's just talk about the impact that this is going to have on your business, whether or not small businesses should support higher minimum wages. You make the case that this is good for business. Why?
Well, since we opened 30 years ago, we've always paid above minimum wage, and we continue to do so. In fact, over this holiday season, we've increased wages for several of our employees up to $13 an hour, and 2 of them up to $15 an hour. The reason being, these employees are by me considered an asset, an investment in our business, whereas I think a lot of small business owners look at employees as a liability because of the cost. But that cost is tremendously offset when you have to hire employees, you have to train them, you're having extra people on the clock while you are training them, and then you just never know how they're going to turn out. So when we get employees, we do a 2-week screening with them to see if they accept working at our business and if we feel they'll fit into our business. And then we make sure that we pay them good enough so that they're good with customers, happy to work for us, and they remain with us. Our retention rate is extremely high, and that really offsets the cost of going to Indeed, where you can spend thousands of dollars and maybe not get the qualified employee you want. We're also adding healthcare the first of the year to our core group of employees, which is about 7 of the employees that are uninsured right now. We're going to pay health insurance for them and get them covered.
Now, health insurance makes sense to me, but in terms of minimum wage, how does it help you with turnover? When everyone's required to pay that same minimum wage, it might keep them from going to another state. How is it going to keep them from going to another business?
It's the wage we pay. Like I say, we pay between $13 and $15 an hour now. We were paying that before the initiative to raise the minimum wage here in Nebraska when it went in effect. And it's just the customer, the clientele base we have, our staff, our owners, everybody just gets along so great. They find it just a fantastic place to work. It's a lot better working for us for $15 an hour than McDonald's running a cash register for $15 an hour, and they realize that.
Now, the Congressional Budget Office, which is bipartisan, nonpartisan, in fact, they say that increasing the minimum wage act would kill 1.2 million jobs by 2026, 1.8 million jobs by 2030. Look, without diving into the analysis and getting caught into the weeds, what do you think of that from the CBO?
Well, I think one thing, it's going to force small business owners to reevaluate their business. Like I say, the majority of money that we spend, our payouts, is to marketing and labor, employment, wages. But that provides 2 things. One, the marketing increases our business, and paying a fair wage to our employees. They're the first people that are seen when the customers come in the door. They're one of our best forms of advertising. Because those customers are satisfied when they leave. They'll go home and tell their family, their friends, their associates, and it increases our business. So I see people that feel it's going to impact their business, and maybe even feel like some are going to go out of business. It's a matter of building your business up, and that's what we've spent 30 years doing, and we brought our employees along with us doing that. And we pay them a fair wage because that's a huge part of our business.
Culture is indeed key. Owner of Wild Bird Habitat Stores in Nebraska, Dave Titterington. Appreciate you being with us. Thank you. All right, Shauna, what's trending after hours?
Got a couple of stocks for you here, Dave. We have Nike, FedEx, and Workday. Let's kick it off with Nike. We're looking at gains of nearly 7% now after hours. It has been searching for direction for most of extended trading, but the news here, or the move, I should say, coming after Nike actually posted pretty solid results. A second quarter revenue beating expectations. The company's gross margin for the quarter, 42.9%. That was also better than what the street was looking for. Inventories, though, was one line here of this earnings report that Wall Street is taking some issue with. We just heard from Adrian Yee at Barclays saying that inventory levels still very weak here for Nike. That's because total $9.3 billion. That's up 43% year over year. Promotional activity, inventory levels, of course, will be a topic that analysts will be looking for a little bit more details on the call this afternoon. But again, the move higher here, up nearly 7% after hours. Let's take a look at FedEx. That's now moving to the upside, up just about nearly a 4% higher here. Now, their full year profit view did disappoint, but a big reason why we're seeing the stock move higher here after hours is because of the additional cost-cutting measures that FedEx has just laid out in its most recent report. And FedEx saying that it is acting quickly to rein in some of those costs, adding $1 billion of cost savings beyond the September forecast. Also, the fact that demand slowdown is sending some worrisome signals just in terms of what it could mean not only for FedEx, but more broadly speaking for the industry at large. At least for after hours, though, it looks like Wall Street's mainly focused on some of those cost-cutting measures, also some of the better than expected results that we got for its most recent quarter. Again, we're looking at gains after hours. An executive shakeup at Workday, that's sending the stock off nearly 2%. So Chano Fernandez is stepping down as co-CEO. The new co-CEO that has just been named is Carl Eskenbach. Now he is expected to assume the sole CEO responsibilities in 2024. But again, Workday reacting negatively to this report, at least initially, with the stock off, Dave, just about 2% in extended trading.
Okay, Shauna, thank you. My stock to watch for tomorrow is Carnival Corporation, ticker CCL. The cruise company is set to report its fourth quarter earnings ahead of the bell. Analysts are expecting a loss of 87 cents per share and revenue of $3.9 billion. We'll be listening to the call to hear what the company has to say about demand as more and more people do indeed feel comfortable traveling again. Carnival shares have been hammered this year, as you can see, off about 60%. Coming up, a new website that lets you buy the things you see right from your favorite shows will tell you how you can dress like the characters from Yellowstone and other hit shows.
You have no friends in this building, John. You're gonna have to bring your own.
What you gonna do first? What do you think I'm gonna do? You're all fired.
I love it when she gets mad. It means I'm gonna make a lot of money.
The Kevin Costner Western drama Yellowstone continues to deliver massive ratings in season 5, and its impact even being felt in the fashion world. Western wear spiking in popularity from coast to coast, even right here in the unlikeliest of places in Manhattan. And if you want to look exactly like John or Beth Dutton, or my personal favorite, Rip, Shop the Scenes has you covered. Jill Martin is the co-founder and CEO of Shop the Scenes and joins us now. Jill, great to see you. How do I look? And most importantly, how does this work, my friend?
I'm overwhelmed with the dress up for Yahoo Finance. And I've rarely been on this in sweats, but this seems appropriate because we are talking about dressing and looking like a Dutton and like your favorite character. So first of all, thank you for having me. Honored to be here. And welcome to my apartment, which is really a pop-up store right now. But what's so cool about this is we're teaming up with the showrunners and the costume and the set designers to bring the authentic items from the show that you see it, you love it, and then you buy it with one click. So we've recreated these virtual rooms working directly with the creators of the show. My partner is the owner of 101 Studios, which owns Yellowstone. So here is the beautiful access we had to the Dutton dining room. And what we're finding is people want to live and look like a Dutton, from what they dine with to what is in the bunkhouse. As you see here, this is roaming our virtual room. And we're selling actual furniture. John Dutton's chair that he sits in when he wins governor, I mean, those are $3,600 chairs that people are buying. And they're also buying baseball hats and T-shirts like you're seeing that you're wearing today. That sandbag that you just saw sold out 4 times. So it's really running the gamut of what people want. And that's really authenticity.
Yeah, Jill, talk to us a little bit about the demand, because I'm in the coat right now, Beth's coat, which retails for almost $1,000. I have the trucker hat on, just in terms of what people are buying, how much they're spending, how much time they're spending on your site. What are you seeing engagement-wise?
Yeah, I mean, it's really cool. Listen, we launched November 13th, so I don't have all the answers yet. But what I can tell you is a jacket like yours, which I love, it's very rare
it's
you
warm.
get to dress up
It's
on
warm.
your show.
I'll give it that.
So it's a triumph. It is a triumph. That is Beth's faux fur jacket that she got married in. And the costume designer, Janetta Boone, is very specific about Beth's outfits and the specific outfit she chooses for her, and it's so authentic. So the cowboy hat you're seeing right now, the jacket you're wearing has sold out 4 times. The boots, everything that is authentic to the show, to the hat that you're wearing, the authentic Yellowstone hat. What people know when they come to Shop the Scenes, it's not inspired by, it's not it may look like, it's the actual item you see in the show. Or what I'm wearing right now is with Emily in Paris, which launches tomorrow, season 3. And we have developed with Darren Star where we are bringing the fictitious brands, the in-show brands to life. So Pierre Cardot, do you guys watch Emily in Paris?
I've seen it before. I'm not an avid watcher, but maybe I will be for season 3.
Okay, so like this guy. Okay, so here's the cast. We lit up the Empire State Building this week pink, and we kicked off our Shop the Scenes party. Now with this show, what we're doing is Darren Star, what a brilliant creator. The concept of the show is Emily pitches brands in the show, and you're seeing the cast smiling here. A lot of them at the Empire State Building for the first time, in America for the first time at that. But what we're doing is we're taking the brands that you see just in the show. You see the suitcase right there. This is Pierre Cardot. And this suitcase, a version of it was in the show. And then we're making it accessible in real life. So tomorrow, when you are watching episode 6, you will see a storyline on a perfume, and they are immersed in Provence in the lavender fields. And of course, something happens, because something always happens. And we developed with Darren Star perfume that really captures the essence of Provence. So as the viewer's watching, you're able to buy in real time into the storyline.
Yeah. Jill, I'm curious, these shows, Yellowstone and its spin-offs, are very theme-heavy, theme-unique, Western, and of course, Emily in Paris. Will it work with general shows? I think back to like Seinfeld or Friends, of things like that are just kind of general themes. And what are the implications as we move forward? Because could we see this with the NFL and Black Friday games streaming on Amazon?
Yeah, so it's very, very hard for me to talk business with you dressed like that, but I'm in because I'm
This is my hat, by the way.
Sweatsuit. I know it is. Believe me, I know all our items. So it's interesting because not every show works in its entirety. Yellowstone is out of central casting because Country Couture is very in right now, and all the pieces are items that you want to use. It's shot in pretty much current day. So some of the shows that we're announcing, and we're announcing 20 to 25 shows in the coming year, are old shows that you loved, and you named a couple, but that at that time you couldn't buy brands. I mean, think about all the things you've seen over the years, not to date our age, but that you couldn't buy that you wanted. I mean, that's like, have you ever seen something and wanted to buy it? So we're not only bringing back shows and doing capsule collections around it, we're also taking new shows and bringing the items from that show to life. So does every show lend itself like a Yellowstone? The answer is no. But for every show, like Tulsa King, for example, one of the quotes he says was, they ask him what he does, with a few vulgarities, and he says, I'm an industrialist, because that's what people answer, because no one knows what that is. So what a great quote for a t-shirt. So that would be something that we would take from a show like that. So it's really, as a curator and for me as a merchandiser and an entrepreneur, looking at something and saying, what will work, what doesn't? And just looking at you guys right now, I feel like my dreams have come to reality.
Well, it's
if
so
we got
much
her
fun.
boots. If we got her Beth
and
boots.
I need boots for next time we do this. But Jill, we were talking about it ahead of this segment. It makes so much sense. It's a way to involve the viewers out there, fan engagement. We wish you all the best. We look forward to seeing what shows come next for you and the company. All right, well, Jill Martin, thanks so much for joining us this afternoon. Well, that does it for us today on Yahoo Finance Live. A fun little way to end the show today. We'll see you right back here again tomorrow. Have a great night, guys.